It's a question you've probably asked yourself a bunch of times, right? We see these huge headlines about massive, incredibly profitable companies paying a tax rate in the single digits, sometimes not paying anything at all. How on earth is that possible? Well, for decades, that was just how the game was played. But now, the rules of that game are getting a complete rewrite.
And today, we're going to break down one of the single biggest shifts in international finance in a century, the global minimum tax. This is a huge, coordinated effort by over 130 countries to fundamentally change the rulebook on how corporations are taxed. So let's dive in and see how this global tax revolution is actually playing out.
So here's our game plan for today. First, we're going to look at the big problem that made this whole thing necessary. Then we'll unpack the new 15% global rule, see exactly who it applies to, break down the super clever mechanism that makes it all work, and finally, take a look at what this new tax landscape really means for everyone.
All right, so first things first. To really get this, we have to understand the core problem that started it all. For years, the global tax system has been dealing with this huge issue called profit shifting.
So picture this. Countries were basically in a bidding war with each other, slashing their corporate tax rates lower and lower to get big companies to set up shop. And of course, these huge multinational corporations got incredibly savvy. They figured out how to report their profits not where they actually made the money, but in whatever low-tax country, a tax haven, gave them the sweetest deal. This just created this downward spiral, a race to the bottom, where governments everywhere were losing out on a ton of tax revenue.
And to stop this race, there was really only one option. Everyone had to get on the same page and work together. The solution they landed on is this really powerful, coordinated agreement to basically put a stop to this endless undercutting.
And this is it, the global minimum tax, or GMT. The idea is so simple, but honestly, it's revolutionary. The deal is, no matter where a multinational company decides to book its profits, it's going to face an effective tax rate of at least 15%. This just pulls the rug out from under the whole incentive to shift profits to some zero-tax island. That 15% floor, that's the whole ballgame.
Okay, but you might be wondering, does this apply to every single company out there? Nope. It's specifically designed to go after the biggest of the big players on the global stage. So, who exactly fits the bill?
It all comes down to this number right here, 750 million euros. That's the magic number, the line in the sand that separates the companies that are in from the ones that are out. So let's get into the specifics. We're talking about multinational groups, a parent company with all its subsidiaries scattered across different countries that pull in a combined annual revenue of 750 million euros or more. And check this out. To make sure it's not just a one-hit wonder, they have to hit that target in at least 2 of the last 4 years. This really zooms in the focus on, the top 10,000 or so biggest companies on the planet.
Right, so a 15% minimum rule sounds great, but how do you actually enforce it across the entire globe? This is where the whole system gets really, really clever. Let's break down how this top-up tax actually works.
So the first thing you have to wrap your head around is something called the effective tax rate, or ETR. Now, this is not the headline corporate tax rate you see a country advertising. Oh no. The ETR is what a company actually pays on its profits in a country once you factor in all the deductions, the credits, all the little loopholes. That's the number that really matters here.
This gives you a perfect picture of the core idea. Let's just imagine you have a big company operating in country X where, after everything's said and done, it's only paying an ETR of 8%. Well, the global minimum is 15%. That creates what they call a 7% tax gap. In the old days, that 7% just vanished. It was lost revenue for governments. But this new system, it's designed to go get it.
And here's exactly how they do it. First, you calculate that gap. 15% minus the 8% they paid, that leaves 7%. Then, the top-up tax kicks in. And here's the crucial part. The home country of the parent company gets to collect that extra 7%. So even if the profits were sitting in country X, the tax money flows back home. The end result? The company's total tax bill on those specific profits is now effectively 15%. Problem solved.
And the system has this brilliant 1-2 punch to make sure it always works. The main rule is called the Income Inclusion Rule, or IIR. That's what lets the parent company's home country collect the tax. But what if that home country just decides not to? Well, there's a backstop for that. It's called the Undertaxed Payments Rule, or UTPR. This is the safety net. It basically lets another country, where the company operates, step in and collect the tax. So one way or another, that tax is getting...
All right, so we've been deep in the weeds on the what, the who, and the how. But let's pull back for a second. What does all of this actually mean for the global economy? Why should you even care about this?
Now, there's a really important piece of nuance here called the substance-based income exclusion. The goal isn't to punish companies for having, real operations somewhere, so the rules actually include a carve-out for tangible things like factories and payroll for actual employees. It's a way to reward genuine economic substance, not just an address with a post office box in a tax haven.
When you get right down to it, this is all about changing the entire game. By setting a global floor, the GMT pretty much eliminates the main reason for companies to go hunting for the absolute lowest tax rate. I mean, think about it. Your local domestic business down the street, it's always paid the local tax rate, period. But its giant multinational competitor could just slash its tax bill by moving profits around. This new rule starts to level that playing field. It means countries are now going to have to compete on things that actually matter, like having a skilled workforce or incredible infrastructure, not just a low tax number.
And that, of course, brings us to the final massive question. If you take away the primary incentive for shifting profits around, does this new global tax system spell the end for tax havens as we've known them for the last 50 years? The revolution is definitely underway, but only time is going to tell just how much the landscape has truly changed.